Can you envisage a world where cryptocurrencies are the norm? How would this digital revolution be shaped by the sword of regulation? Welcome to the rapidly evolving world of cryptocurrencies, a universe where innovation dances with the intricate steps of governance. It's a realm that's as exciting as it is complex, where the future of finance is being rewritten with each passing day. But amid the buzz of Bitcoin, the allure of altcoins, and the promise of blockchain, a significant player is often overlooked: regulation. Regulation in this context is not just about rules and restrictions, it's about creating a balance, a delicate equilibrium between fostering innovation and ensuring stability. It's about paving the way for widespread adoption while ensuring consumer protection. It's about allowing the phoenix of cryptocurrencies to rise, all while keeping a watchful eye on the flames. But why is regulation so important in the world of cryptocurrencies? Well, imagine a football match without a referee or a city without traffic rules. Chaos, right? Regulation brings order to the dynamic and often volatile crypto market. It provides a framework within which cryptocurrencies can operate, grow, and potentially thrive. And as we will discover, the regulatory landscape is as diverse as the cryptocurrencies it governs. Across the globe, nations are adopting different approaches, shaping their own unique crypto narratives. Some are stringent, building robust frameworks to ensure compliance and stability. Others are progressive, embracing digital currencies and fostering innovation. The impact of these regulatory decisions is profound. They shape market volatility, influence investor sentiment, and even direct the course of technological advancements. Case in point, look at how regulations in one country can reverberate across the global crypto landscape, affecting market dynamics halfway across the world. But the story of crypto regulation is far from over. It's an ongoing narrative in the grand saga of the digital revolution, and as this tale unfolds, it will continue to shape our financial future, one blockchain at a time. Join us as we embark on this fascinating journey to understand the impact of regulation on the future of cryptocurrencies. Scene script. From the east to the west, the approach to crypto regulation varies significantly. What are the implications of these diverse stances? Let's delve into the fascinating world of global cryptocurrency regulation. Picture a spectrum. On one end, we have countries that are stringent in their approach, enforcing tight controls and rigorous checks. On the other end, there are countries that are progressive, fostering a conducive environment for crypto innovation to thrive. And somewhere in the middle are the moderate nations balancing the scales of innovation and regulation. Starting with the stringent nations, we see a clear focus on stability, compliance, and consumer protection. These countries view the crypto world with a cautious eye, often citing concerns about potential misuse in illicit activities, market volatility, and the risk of consumer losses. Countries like China and India fall into this category, with strict regulatory frameworks that have sometimes involved outright bans on certain crypto activities. Now let's pivot to the progressive side of the spectrum. These countries see digital currencies as an opportunity to foster technological innovation and economic growth. They're opening the doors wide to blockchain technologies and digital currencies, often with favorable tax laws and regulatory frameworks. Switzerland and Malta are perfect examples of this approach, positioning themselves as blockchain-friendly nations and attracting a host of crypto businesses. In the middle of the spectrum, we find countries that are taking a more balanced approach. These nations are neither fully embracing nor outright rejecting cryptocurrencies. Instead, they're cautiously exploring the potential benefits, while simultaneously ensuring consumer protection and market stability. Countries like the United States, the United Kingdom, and Singapore fall into this category, with regulatory frameworks that are evolving in tandem with the crypto landscape. So why does this matter? Well, the stance a country takes towards cryptocurrency regulation can significantly influence its economic landscape. Stringent regulations can often deter crypto businesses, leading to a slowdown in technological advancements in these regions. On the other hand, a progressive stance can attract a plethora of crypto businesses, fostering innovation but also potentially increasing the risk of market instability. Moreover, these regulatory stances are not static. As the crypto landscape evolves, so too do the regulatory approaches of these nations. The crypto world is, after all, still in its nascent stage, and as it matures, we can expect to see regulatory perspectives shift and adapt. In essence, the world of crypto regulation is a complex and dynamic arena. The push and pull between innovation and regulation is a delicate balancing act that countries around the globe are striving to master. The contrasting regulatory approaches across the globe offer a fascinating insight into how nations are navigating this uncharted territory. Understanding these regulatory approaches is key to grasping the impact of governance on the crypto market. As we continue our exploration, remember this spectrum. It's a crucial tool in understanding the intricate dance between innovation and governance in the crypto world. The ripple effects of regulation can be felt far and wide in the crypto market. How have specific regulatory decisions shaped the crypto landscape? Let's begin with the United States, a nation known for its stringent financial regulations. It's no secret that the US has been cautious in its approach to crypto. A key example is the Securities and Exchange Commission's decision to classify some initial coin offerings, or ICOs, as securities. This move created a significant ripple effect as it subjected the involved parties to the existing securities laws. The decision also brought about a shift in investor sentiment, with many becoming wary of participating in ICOs for fear of legal repercussions. Despite the added scrutiny, this move has also served to protect investors from fraudulent schemes, underscoring the importance of regulation in ensuring market stability. Now let's move to the East, where Japan stands as a beacon of progressive crypto regulation. Japan was one of the first countries to recognize Bitcoin as a legal method of payment back in 2017. This decision played a pivotal role in legitimizing cryptocurrencies and fostering widespread adoption within the country. However, it wasn't all smooth sailing. Following the high-profile hack of the coin check exchange in 2018, the Japanese Financial Services Agency implemented stricter regulations for crypto exchanges. These measures, while initially causing a drop in market activity, ultimately enhanced investor confidence and strengthened Japan's position as a secure hub for crypto trading. In stark contrast to Japan's embrace of digital currencies, we have China. China has taken a decidedly more prohibitive stance, banning ICOs and crypto exchanges back in 2017. This decision sent shockwaves through the global crypto market, leading to a significant drop in Bitcoin's price. More recently, China's crackdown on Bitcoin mining due to environmental concerns has further affected the market, causing increased volatility. The Chinese government's tough stance on crypto has certainly posed challenges for the industry, but it has also sparked innovation in the form of decentralized exchanges and mining operations, relocating to more crypto-friendly countries. Finally, we turn our attention to India, a country with a rapidly growing interest in cryptocurrency. India's regulatory journey has been a roller coaster ride, with the Reserve Bank of India initially banning banks from dealing with crypto businesses in 2018. However, this ban was subsequently overturned by the Supreme Court in 2020. The reversal of the ban brought about a surge in crypto trading in India, demonstrating the significant impact of regulatory decisions on market dynamics. Despite the uncertainty, India's crypto industry has shown remarkable resilience, with startups innovating to meet the growing demand for digital assets. As these case studies highlight, regulatory decisions can significantly influence market dynamics and investor sentiment. Each of these cases illustrates the delicate dance between innovation and regulation. They underscore the profound impact that regulatory decisions can have on the global crypto landscape, shaping market dynamics, influencing investor sentiment, and driving technological advancements. As we continue to navigate through the ever-evolving crypto frontier, it's crucial to understand that the dance between innovation and regulation is far from over. It's an intricate interplay that will continue to shape the future of this burgeoning industry. The challenge lies in striking a balance, ensuring market stability and investor protection while fostering innovation and growth. Only time will tell how this delicate balance will be achieved, but one thing is certain: the journey is sure to be an exciting one. Regulation isn't just about rules and restrictions. How does it foster or hinder innovation in the crypto industry? Let's dive into the heart of this fascinating interplay between innovation and regulation. While many might view regulation as a hurdle to innovation, it's worth noting that it can also act as a catalyst. Regulatory clarity provides a defined playing field for innovators, allowing them to navigate the landscape with a clear understanding of the boundaries. Consider the early days of the crypto industry. The lack of regulation led to a Wild West scenario with numerous scams and frauds tarnishing the industry's reputation. The introduction of regulations brought a degree of stability and trust, essential prerequisites for any industry's growth. However, the relationship between regulation and innovation isn't always so harmonious. There have been pivotal moments where regulations have posed significant challenges to the crypto world. For instance, stringent regulatory frameworks can stifle innovation by creating high barriers to entry and limiting the scope of experimentation. One such example is the initial coin offerings, or ICOs, a revolutionary fundraising method that emerged alongside the rise of cryptocurrencies. ICOs allowed startups to bypass traditional fundraising methods, offering a new avenue for innovation and entrepreneurship. However, the lack of regulation led to numerous scams, prompting regulators to step in. While necessary to protect investors, these regulations also pose challenges for legitimate businesses trying to leverage ICOs. On the other hand, progressive regulatory frameworks can foster innovation by creating an environment conducive to experimentation and growth. Take the example of countries like Estonia and Switzerland, which have taken a proactive approach to crypto regulation. They've created sandbox environments where crypto startups can experiment and innovate within certain regulatory boundaries. This approach has led to a flourishing crypto ecosystem in these countries, attracting innovators and investors from around the world. Another critical aspect of regulation is its impact on investor sentiment, a key driver of innovation in the crypto industry. Regulatory clarity can boost investor confidence, leading to increased investment in the industry. This, in turn, fuels innovation by providing the necessary funding for research and development. However, regulatory decisions can also have a negative impact on investor sentiment. For instance, when China announced a crackdown on cryptocurrencies, it led to a significant drop in the market, affecting investor confidence and potentially stifling innovation. So, the relationship between regulation and innovation is complex and multifaceted. It's not a simple case of more regulation equals less innovation or vice versa. The key lies in striking the right balance. A regulatory framework that protects consumers and maintains market stability, while also allowing room for experimentation and growth. This delicate balance is perhaps one of the greatest challenges faced by regulators in the crypto industry. Too little regulation can lead to instability and scams, undermining trust in the industry. Too much regulation can stifle innovation and limit the industry's potential. Finding the sweet spot is a challenging task, requiring a deep understanding of the industry and a willingness to adapt and evolve as the landscape changes. In conclusion, regulation plays a crucial role in the crypto industry's innovation, acting both as a catalyst and a challenge. It's an intricate dance, a delicate balancing act that shapes the industry's evolution and future. Striking a balance between security and innovation is one of the greatest challenges faced by regulators in the crypto industry. Licensing requirements, tax frameworks, consumer protection. The devil is in the details when it comes to crypto regulation. But how do these details influence the broader economy? Let's start with licensing requirements. In many jurisdictions, cryptocurrency exchanges and businesses are required to obtain licenses to operate. These licenses are a form of regulation meant to ensure that these businesses adhere to a certain standard of practice. For instance, they may need to demonstrate robust security measures to protect customer assets or prove they have sufficient capital to manage risk. These requirements can be a barrier to entry for some businesses, potentially stifling innovation. However, they also encourage a level of professionalism and trustworthiness within the industry, which can boost investor confidence and foster growth. Moving on to tax frameworks, these can have a profound impact on both businesses and individual investors. For businesses, how cryptocurrency transactions are taxed can affect their bottom line. Are they treated as capital gains, income, or something else entirely? The answer can drastically change a company's tax liability. For individual investors, it can influence investment decisions. If crypto gains are taxed heavily, it may discourage some from investing or lead them to hold onto their assets for longer to minimize their tax burden. Consumer protection is another key aspect of crypto regulation. This can range from ensuring businesses have adequate security measures in place to protect customer assets, to implementing rules around transparency and disclosure, these protections are crucial in building trust in the industry. They give consumers the confidence to invest in cryptocurrencies, knowing that there are safeguards in place to protect them. But they can also impose additional costs on businesses, which could potentially be passed on to consumers. So what's the impact of all this on the broader economy? Well, the effects are manifold. On one hand, stringent regulation can deter some businesses and investors, potentially slowing the growth of the industry. On the other hand, it can also foster a more secure and trustworthy environment, encouraging more widespread adoption of cryptocurrencies. This could stimulate economic activity as businesses and consumers engage in new types of transactions and develop innovative products and services. Moreover, the tax revenue generated from cryptocurrency transactions can also contribute to the economy. This revenue could be used to fund public services, infrastructure, and other government initiatives, but this depends on the ability of governments to effectively track and tax these transactions, which is a challenge in itself. In conclusion, the specifics of crypto regulation, from licensing and taxes to consumer protection, can have far-reaching impacts. They shape the industry's growth, the behavior of investors, and the broader economic landscape. Understanding these details is crucial to grasping the complexities of crypto regulation. What might the future hold for crypto regulation? How might the dance between innovation and governance evolve? As we venture into the realm of speculation, we might glimpse potential future trends in the world of cryptocurrency regulation. Let's paint a picture. We see a world where technological advancements continue to shape and shift the crypto landscape. Blockchain technology, the backbone of cryptocurrencies, could become more sophisticated, enabling more secure, efficient, and diverse applications. With these advancements, we may witness a corresponding evolution in regulatory frameworks. Governments may need to adapt their regulations to keep pace, ensuring that they can effectively oversee these new developments without stifling innovation. Shifting global attitudes towards cryptocurrencies could also play a significant role in shaping the future of crypto regulation. As more people become aware and accepting of digital assets, there may be increased pressure on governments to create regulatory environments that foster rather than hinder the growth of this innovative industry. We could see more nations adopting progressive stances, encouraging the use of cryptocurrencies and recognizing their potential to revolutionize the financial sector. On the other hand, we must also consider the potential challenges. As the crypto industry grows, so too might the risks. Issues such as market volatility, cyber threats, and fraudulent activities could become more prominent, necessitating more stringent regulations. Governments will need to strike a delicate balance, ensuring the security and stability of the crypto market while also encouraging the continued innovation and growth of this dynamic industry. These are just speculations, of course. The future is, after all, unwritten. But as we continue to navigate the intricate dance between innovation and governance, these trends provide food for thought, a glimpse into what the future of crypto regulation might hold. As we gaze into the future, one thing remains certain. The story of crypto regulation is far from over. This complex, ever-evolving narrative is a crucial component of the ongoing digital revolution, a revolution that is reshaping our financial future. And if you enjoyed this content, like and subscribe to receive more. Thank you for your support.